Hi, this is Vijay Bambani. I'm back again with you to talk about an aspect of trading that concerns us all. Whether you should follow the momentum style of trading or you should go for contrarian style of trading. Both these are as different as chalk and cheese. Momentum style of trading is where you go with the flow, follow the money trail, ride the tail of the money, make some profits, get off the bus before it stops moving. You could be an intraday trader, you could be a swing trader, or you could be a momentum based investor. You're basically going with the trend. Now, typically speaking, going with the flow gives you money relatively faster. So the returns are faster. Whereas contrarian style of trading is where something is rising and you're selling it or short selling it, or alternately, something is falling and you're going long or buying it in the expectation that ultimately it is your calculation which will prevail and be proved correct. As you would have guessed by now, contrarian style of investment or trading takes a while because the markets can go against you for fairly prolonged periods of time. Provided you are right, in the end, ultimately, you will take home bigger amounts of profits, but till the trade is open, you will be nursing the trade, putting out payments towards mark-to-market notional losses, span margins, and any ad hoc margins imposed by the exchanges. So to that extent, momentum-based trading is not really as capital intensive as contrarian trading is. And contrarian trading, on the other hand, is A, for the mentally tough trader, and B, deep-pocketed, cash-rich, cash-flush trader. Within momentum style of trading, again, there are two ways you can aim to make a hypothetical figure of 5,000 rupees. A, buy 500 shares, wait for a 10 rupee move and make 5,000. B, buy 5,000 shares, wait for a 1 rupee move and then make 5,000. Here again, these two are as different as chalk and cheese. In the exposure that you're taking in 500 shares, your stress levels are much, much lower. Your risk may also be relatively lower. When you're trading 5,000 shares for a 1 rupee gain, you will be like a cat on a hot tin roof. You will be nervous. Any adverse price movement will basically start making you perspire behind the ears. You would need to know which kind of a market it ongoingly is before you can trade any one of these two techniques. In a trending market, you want to go with 500 shares with a 10 rupee gain. In a non-trending or a chicken market, it will force you to take bigger exposure to earn the same amount of money. So alpha or absolute profits are a little more difficult to get in a non-trending market. Let's come to contrarian investing. You think the prices are mispriced. Things are completely out of whack. They should not be so. You expect the price to return back to the mean, or what is known as the statistical mean, a central point, an equilibrium level. And you're betting against the price at that point in time, expecting it to revert back to the mean, where if you are long, you will liquidate longs, or if you're short, you will cover your shorts. Do you remember the trade that I recommended after Saudi Aramco's drone attacks in my YouTube video? I recommended a sell, quoting that this was not an oil well problem, but an oil refining problem. And we were proved right. We called the market's bluff. We said that the price was mispriced and therefore should return back to equilibrium. But hey, this was an absolutely difficult trade for me to give out on the public domain. I really went through a lot of perspiration before giving out that video to you because I knew that prices could stay out of whack for a fairly long periods of time. Now, from a trader's perspective, what does this style of trading demand from you? Number one, you need to be completely icy cool, nerves of steel, and a person who doesn't really get shaken up very easily. Which means you cannot be faint-hearted, you cannot be nervous, and you should not scare easily. If you are tenacious in your mind and body, then contrarian style of trading may just suit you fine. If at all you're a nervous kind of a person who doesn't like excessive risk, please do not even attempt contrarian trades. Trading is, in a sense, a journey of self-discovery. A trader will make more money provided he or she tries to enter trades which are more suited to his or her personality. If you're trying to be something that you are not, the results are not likely to be right. So, determine what kind of a person you really are. Do you fall into the timid category or do you fall into the gutsy category? And then start to take bets on the market, either on the momentum front or on the contrarian trade front. Which one of these is right and which one of them is wrong? Hey, there's no easy answer to that because there is no such thing as right and wrong. Do whatever suits you, do whatever that gives you results. As the Arabs say, praise be to that which strengthens. And to us traders, the only thing that strengthens is profits. Till we meet again, this is Vijay Bambwani signing off for now. Do not forget to click like on this video if you're watching it on YouTube. Please subscribe to my YouTube channel. Feel free to share this video with your family and friends. And do let me know in the comment section what you think about this video and if there are any other topics that you would like me to shoot more videos in the future for you. See you again. Bye-bye.